There's a lot of stress in multifamily. There's a lot of inventory in condos out there. When the headlines stink, it's often a good time to buy for long-term wealth building. What's up, Colorado? Chris Lopez here, and today is our monthly market podcast. We're going to be talking about trends, news articles, and deals for the month of January 2026 already, and really talking about the Denver and Colorado Springs markets. So in the studio, I got Troy Howe with Nova Home Loans, Jeff White with Envision Advisors. Remotely down in Southern Colorado is Jenny Bayless. And then a new face to our monthly market podcast is Shawn Riley with Keyrenter Denver. He's filling in for Brandon, who I think is in Disney World this week.
Nice.
So glad to have you.
Yes.
So glad to have you on the show today, Shawn. Thank you for jumping in, man.
Happy to be here.
So we're going to talk trends, and then we'll go into rental trends, news articles, and some deals, and just have some general talk and shop about the market. But Jenny, we always like to start with what's happening down in Colorado Springs. So what is happening down there?
Yeah, I think the key point to highlight for this month, and this is for January 2026, is that new listings almost doubled. They went from December 2025 to January 2026, 739, and this is single family homes, to 1274. So I don't know. I mean, I know that we were talking about that in past months, how people are just kind of like hanging tight, but maybe they just waited till after the holidays. I don't know. But that's a pretty drastic jump. But seasonality wise, that's pretty much in line with what it was January 2025. So it's not odd, generally speaking, but it is a massive jump from one month to another. And then sales went down quite a bit as well, by about 300 units, so 30%. So I think a lot of inventory is just sitting there at the moment, which again kind of aligns with the month's supply. It went from 3.1 to 4.5. And I think by most people's metrics, I think that officially tips it into a buyer's market. But interestingly enough, prices really kind of held steady. So median price the prior month was $460K, and then January is $469, which is up 2% month over month, which again, I think we talked about in previous months. That is just a very low sample size. So, take that with a grain of salt, which is down slightly from January 2025, of 482. So I think those are kind of the main highlights that I wanted to point out, for that.
Yeah. And I mean, I wasn't surprised to see prices down, 1 or 2 points over the year on single family. But looking down here at the condos, I mean, a lot of the same stories, just more drastic numbers where, I mean, it's down like 10% year over year for condos and townhomes.
Yeah. But also again, sales, there's only 69 that were sold.
Yep.
so it's such a small population on that. But yeah, same thing that you guys are talking about up north with the HOAs, just kind of hammering everybody on that.
Any, you got any like boots on the ground stories, or just anything you're hearing from investors, other agents down there, or is it all pretty quiet?
Pretty quiet, at least in my neck of the woods.
What are you guys hearing up here in Denver as we get in the trends? What are you hearing, Jeff?
Basically that you have a lot of like relistings. So people that took it off the market last year that are putting it back on, thinking they'll have better luck. So I'm starting to see a lot more of those. And kind of similar to what Jenny said, single family detached homes have held their value and slight appreciation. And then condos, townhomes have been struggling. And I think we'll see that in 2026 as well. It's just single families are a more desirable asset. And I think because you have just more people that want them. And usually the HOAs aren't a big hindrance like you see in condos and townhomes as well when there are HOAs.
Oh.
Especially the condos when it comes to the financing.
Yeah.
Jeez.
Talk more about that.
Yeah.
Those are the curse of the universe.
How many condos did you close last year, Troy?
One really stands out to me. It was kind of painful, but it was a second home purchase up in Steamboat Springs. And so that was a little interesting because it had every attribute of being a condo-tel, which is kind of a Fannie Mae, Freddie Mac no-no. But when you buy it as a second home, there's a limited review that this particular borrower scored. And so limited review allowed for the financing, Jeff. So not always do you get that. If you have to do a full review, you got to really dig into the weeds. And a lot of these condos aren't passing muster.
What's the rule of second home? You have to live there like 2 weeks a year?
No, I just not rented, at least as far as what you're saying when you're buying it. I have the suspicion that they might do a little activity, but they qualify without any income, right? They got to qualify full boat for the full payment.
So move on here to the Denver trends. Now, this is from the Denver Metro Association of Realtors. A lot of the same similarities to what Jenny was sharing, going on in Colorado Springs there. Our new listings went from about 1,760 in December to about 4,500 in January. So we're at like 150% month over month increase. But that's no surprise and basically very similar to where we ended January 2025 at. Now, we did see active inventory build slightly, about 8% up month over month, 7% up year over year. So no drastic changes there. Prices about flat month over month to about negative 1% year over year. So again, very, very similar trends. And we're seeing the same thing with, the difference in detached properties and attached properties as well. But what I wanted to jump down to here was this chart. So this green line shows, the residential properties, and this purple line shows detached. And you can just see we still get these big seasonal swings, and we did not end up that much higher. Just looking at the graph, right? A little bit below 8,000 compared to about 7,000 about this time last year. But you can see that like big trend as it goes up to the peak and then back down the valley, and you can see it, it increasing again. And looking at this, it just looks like the trend line will continue to increase. And based on the data, since demand has not picked up yet, I think inventory will keep building, and we'll still keep seeing prices pretty flat to slightly negative. But there was a couple interesting things that stood out to me in this report. So they have a new section in here, and it said, according to an analysis by Cinch Home Services, Colorado residential land averaged $942,200 per acre in 2022, up from $343,000 in 2012. 174% increase, one of the fastest gains in the nation. So, just massive gain in land value there, which is no surprise. That's why we're seeing prices go up. People don't really build starter homes or affordable housing anymore, right? When it's almost $1 million an acre on average, it's hard to go out there and build starter homes.
Yep. For sure.
Does that stat surprise you guys? Just how much land increase? Like looking at it, it's huge. But like looking back the last 15 years, I wasn't surprised at all by it.
Well, especially look at the average new build townhome or new build detached home. They're not selling them like you just alluded to. Like starter homes don't exist because a starter home would be like a $300,000 to $400,000 house. So they have to sell them for a way more. So what's the point of building a $300,000 to $400,000 house when it costs that much just for the land? And that's not even talking about all the other stuff after they even buy the land, like the water tap fees, I'm sure, out of control. The electric, like running electric and like hooking up to Excel Energy or whatever the electric service provider is. So it just adds up. So that's why the price is just skyrocketed for if you want a new build. And the starter homes don't exist. Like a little 1,200 square foot detached home, they don't sell those anymore.
Just not enough margin.
Yeah. Well, that's where historically condos and townhomes kind of fit the bill, but obviously we know what's going on with condos and townhomes right now.
Yeah.
Yep.
I've got a friend of the family that works for a rather large builder named Richmond Homes. And they've got an inventory issue.
Yeah.
For sure. With some of the houses they've built, they've got a lot of specs sitting around, which is surprising. And
just like in Colorado or nationwide?
I think it's a nationwide type thing wherever they build. So they're trying to figure out how to unload those. And I'm sure they're hoping for the spring. But even with all the builder incentives, which we've seen some pretty crazy stuff, especially when they offer huge buy downs on rates for the financing of those, 4% rates and things, they're still not moving them as much as they'd like to.
Yeah, I mean, that's another thing going on. We talked about inventory being built, and the MLS inventory really doesn't capture like the new build inventory.
Exactly. That price point, that affordability.
Yeah, they'll put in, a couple of their properties into the MLS just to get eyeballs on there, but they don't, they don't report the inventory they have. And so I don't know if shadow inventory is the right word on there, but there's just more inventory. And, builders are in a much more painful situation than most investors or owner occupants are, because they don't have 30-year fixed. They're on some type of short-term debt, usually floating rate debt, and it's 7, 8, 9, 10, 11, 12%.
Yep.
And they gotta move those. And so that's creating more and more downward pressure. So going back on what we've talked about for a long time now, put new builds on your radar.
For sure.
Because there are some good deals out there.
I think there is. You can negotiate with them.
So here's another news article stated in this DMAR report. Colorado now ranks 5th nationally for outbound moves, with 55% of moves leaving the state compared to 45% moving in, the highest outbound since 1990.
Wowza.
Yes.
Yeah.
So, but goes along with the same trends we're seeing, where the population growth has changed. Or has slowed down. Trajectory of us always growing. Well, that started changing a couple of years ago as, I think prices and a lot of other things got really high.
Yep.
All right. Let's move over to talk about rents, because we have Shawn with Keyrenter here to tell us what's going on with some rents. And I always appreciate getting a property manager's perspective on here, because they just see so much more data than we have with their own portfolio. They're talking to renters, they're talking to landlords every day, and their own data sources. So Shawn, you share this article, and then walk us through this and what you guys are seeing in your portfolio.
Yeah, absolutely. So I liked hearing what all you guys had to say, because I feel like rents are being squeezed from many different angles, like the population decrease, being overbuilt. If you have a condo or HOA, those are going up as well. So it's really tough right now for a lot of landlords. It does feel like we kind of got reset back to 2018 on those prices. So if you look at this article, you'll see, we're looking at, I thought what was really interesting, I didn't realize this many units had been built, but about a third of all available apartments were built in the last decade, which that certainly surprised me. And so, we're just pretty much overbuilt at, our current, level. And then we're seeing rents down. This article, lower down, says we were about $88 in decreases year over year. I think that metric is a little lagging. In 2025, I would think every bit of 7 to 10% on condos, specifically condos and townhomes. Now, single family homes do tend to be a little more insulated when it comes to rent decreases, but we're certainly seeing even those come down pretty much across the board. Usually that's probably sub 5% in the last year in decreases on detached. That also, like all of this data, I think one thing really to keep in mind, especially in the townhomes and condos, is this data is not including move-in incentives. When you're doing your market research, really look at a lot of these apartments. They're offering up to 3 months of free rent and like $250 down per deposit. So it's really hard to compete with these guys. And the article even says, if your apartment was built in like the 70s, 80s, it doesn't really have all those flashy amenities. You really have to cut your rental rates to get a tenant in your home. And that's really what we're telling our clients too. In our portfolio, like I said, I think some of this data is a bit behind. We're seeing steeper decreases, but also a lot of our portfolio is those older, we're obviously not managing, these new builds, they kind of do all that stuff in-house. So we're managing a lot of these older condos, older townhomes. And so the only way we can really compete is reducing rent rates. And so maybe that's why we're seeing, what we're feeling is more than just $88 year over year.
Jenny, what are you feeling or seeing down in the rental market in Colorado Springs?
I don't have any specific numbers, but from speaking with other landlords, I think they're kind of feeling the same thing, in that they're having to lower their prices quite a bit, and expect higher vacancy to get a unit filled.
When you come up to renew one of your properties, are you pushing rents or just keeping them as is to keep the tenant in place?
The first tranche, I had a bunch of renewals in March, and I did not raise a penny on those tenants. So yeah, just trying to keep everybody happy and in place.
That's been my approach as well. Jeff, I know you do some room by room stuff.
Mm-hmm.
What are you seeing in the world of room by room? So this is where people buy a 6, 7, 8 bedroom house. You don't have to rooms individually. A lot of times $700, $800, $900 per room on there. What are you seeing with that rental market?
Yeah, same thing. Same trends as this, very flat. And the way to the benefit rent by room is they can move in and move out pretty quickly, right? So they don't have as much stuff as like a normal tenant. But also that's a con, right? Sometimes they say, like they don't give you proper notice, even though the lease says like give us 45 days, 60-day notice. They give you like 30-day or less. Like, I'm moving back home to Maryland or something like that. So to navigate that, sometimes it does create those in-between vacancies where you're getting notice 30 days before, and then you don't find someone that can move in until like the month after. So then you just got yourself a 30 days of nothing. So I'm seeing a little bit of that. And then just for feedback from other investors that do that strategy, definitely a softening and flattening of like looking, because I look at I follow people that post similar listings, right? Do rent by room as their primary strategy or one of their strategies, and just seeing the lack of activity on their listings. And I'm usually the one that likes the listings and all that and saying, great job, or, something like that. But just crickets right now, especially. Rent by room is also seasonal too. So April to August is the best time to fill vacancies, but also it's the time people mostly move. Yeah. So if you have a vacant room in the winter months, even though it's 60 degrees outside right now, it's still February. It's still, you have to plan for, it's just going to sit longer, or you're going to have to do what Shawn talked about, give some incentives and lower it. So instead of being at market 800, maybe you have to do 750 or 725 just to get more people.
So you're seeing, sounds like a lack of demand as well, right? So just based off the non-engagement on Facebook posts?
Exactly. So lack of demand, because probably tying into the lack of people moving here, because the job opportunities aren't the same as it was, 3, 5, 10 years ago. And also a little bit, you could say some of those new builders, right? If they could afford a studio and they're offering 3 months free, $250 deposit or something crazy low like that, I mean, I'd go take a studio for that.
I would too.
Yeah. So I think some of that's being absorbed, taken away from people that would rent rooms.
What about, the last, we've been talking about room by rooms for years, and I feel like the last 2 years, it's gotten a lot of momentum, especially when Polis at the state level passed the law that kind of banned municipalities from having, limits on how many people can live together. You had pad splitting on the market. I've seen from just, local real estate meetups, there's just a lot more people teaching and selling courses around room by room. Do you think any of this has to do with, is there more supply coming online? And do you think that's having any impact on the rental market?
Not at scale, I would say. So I would say it's still kind of small mom and pop investors doing it like on a house or 2 or 3. I know pad splits having some challenges trying to find people to switch over their homes to that, just because most people still don't want to rent a single, like it's hard to transition a thought process. Like the average investor, I want to rent my whole house out to 1 tenant or 7 or 8. That's a big thought. Like they just automatically assume a college, frat house that's just going to get trashed. I mean, it's hard to break that mindset, right? Especially older investors that have the houses, right? That'd be perfect for rent by room. But you are correct. You are seeing the rebranding. There are more people interested, but I still think it's a strategy most people don't pursue because way more operations heavy, way more management intensive not that easy to find tenants for this, right? Because you'll find people that want to rent rooms, but it's more you have to screen for fit. That's true.
Yeah,
How in the world do you screen for fit?
Yeah, they got to play
It's
nice
impossible.
together.
Yeah, because they'll just say exactly like, "Oh, Chris, I'm clean, I'm nice, I get along with others, I like golden retrievers." They'll say exactly what you want to hear, just so you rent the room to them, and like all the time, and that's where they're not your traditional tenant. But because of that, you can get, if you do it correctly, it's a fantastic. I mean, that's why they rebranded it, right? Calling it co-living, because it sounds much sexier than rent by room, right? So you had the rebranding, more promotions, more people trying to promote different products and services for it. So I do think you'll see a transition phase. I know Miller down there in Colorado Springs, he's doing a great job. But that's, give all the credit to him. He has all the systems in place, how to screen people. He has taken it to scale because that's his primary strategy.
Yeah.
But most people that experiment with it, like, oh, I'll try one house, that's not, talk to Miller or someone like that for sure.
Yeah. And we've got a good client down there, Jeremy Babin, that has bought his second home that he's doing rent by room. So I'm working with him right now. We're doing a streamline refinance on his purchase that he just did with Leah last year. And seems, some of those items he has to deal with, but he's living in the second house with his rent by room folks. But the first house is doing well, and he's excited and still happy with the purchase that he did doing rent by room strategy. And
also give you the numbers, Chris. My rent by room rents have been pretty much flat like the last 3 years, to be honest. I have not gotten, and just like, what am I going to raise them $15 a month? Of course, I could have done that. But I value low tenant turnover, right? Because every time you have tenant turnover, as we all know.
Especially when you have good fits.
Yeah,
right?
When they get along, they pay on the 1st or 29th. I like when they pay early. Then I'm like, why would I try to ruin it just for $15 a month or something small? So,
well, turnover just kills NOI.
Yeah. And they're happy. And like, I like longevity. People that stay for years instead of months, even with rent by room. So.
Great. All right. I want to talk about Section 8 rents here for a little bit, because, I mean, that's another strategy we've talked quite a bit about. And at one of our portfolio analysis masterminds a few weeks ago, I'll paraphrase this, but an investor, I don't know, well, he had mentioned along the lines that he had a house in Denver, or a property in Denver, I should say, Section 8, and that Denver cut his tenant's voucher from $3,200 to $1,500 mid-lease. So we're talking like a 50%, greater than 50% reduction, which blew my mind. I have never seen that, just an arbitrary cut in rent. I'm curious if you guys have ever seen anything like that, what you guys are seeing from your Section 8 stuff.
Yep.
I have.
Yeah.
You have, Jenny?
I have. One of my tenants who was on Section 8, she got like a substantial income increase. And I know that part of the program, to comply with the program, is you have to report to the housing authority once your income changes. So I don't know what calculation they use, but I know that the tenant themselves is responsible for paying a certain percentage of their monthly income. And since hers increased so much, they reduced her voucher to kind of like level out on that. But I mean, the rent still stayed the same. It was just, but it was honestly between her and housing and what they've agreed upon, was my understanding.
Yes, I see it. Sometimes I've seen it actually more the last 6 to 9 months more so. So I've had some tenants just get their voucher downgraded. So like that 3,200 number is probably, I can just tell you offhand, it's probably a 4-bedroom. And to go to 32 to 15, there's probably more context to the story, but most likely what happens, kind of what Jenny's alluding to, but also sometimes their voucher changes when kids move out, and adult kids I'm talking about. So they might have a 4-bedroom voucher. The 18-year-old kid moves away, gets downgraded to a 3-bed, sometimes 2. And a 2-bedroom doesn't pay the same 2,201 in that example versus 3,200.
Yeah.
So if kids move out, or like the boyfriend moves out, if all the people on the voucher, that they give a voucher based on the number of people, and each municipality is slightly different. Sometimes they say if 2 kids are the same gender, they could be in one room. If they're different genders, they could be in separate rooms. So they have different ways of doing that. But if things change, like if they had kids or watching their sister's kids and the sister takes the kids back, their voucher gets downgraded, and I have seen that happen, then the housing authority makes that adjustment and reduces the total voucher amount and how much they pay. Or if they lose their job, kind of the opposite of what Jenny said, like if they make less money, then it also goes down how much their portion, because they pay based on 0 to 30% of that total voucher is the tenant's portion. If they make more money, they pay more. If they make less, they pay less.
Yeah, I've seen it where, life changes, where kids move out or, income increases.
Yeah.
The way this landlord was talking about was just sound like an arbitrary cut where all of a sudden, we cut you by half, which just surprised me and shocked me. But you guys aren't seeing that in your portfolio, right?
And the HUD secretary, I forgot his name, he was talking about changing the rules back when he met with the House and Senate committees of like, there's going to be, we want to put it on the states. We want to do like a 2-year limit on like, and all that stuff was ideas that they proposed, but nothing became of it. They actually
nothing
funded,
stuck, right?
Yeah. So 2026 budget was just passed, I think, last week. And they actually paid more for the housing voucher program. So nothing.
That's good news.
Yeah. So it helps, especially those municipalities that were just waiting because they had and then Denver. So Denver was paying, this is the other crazy thing, and I'm sure Shawn's probably noticed it too, for the Section 8s in Denver. They were paying 120% of the fair market rents. Most municipalities pay just, 1-to-1 ratio or 100% of it, right? Or like you look on HUD website, fair market rents, you see Aurora pays $32.55. Denver is paying 20% higher than that number across the board to attract more landlords to the program. So when the new president got elected, and they had to literally send out letters saying, "Don't ask for rent increases. Please don't do that." And they had they didn't issue any new vouchers for 2025. So that affected a lot of people that were on that lottery system that can't get it now, that are going to stay in the lottery for probably next few years at least. And then the people that are existing, Denver's doing everything they can not to, refusing rent increases basically, if you try to ask for it, which I tried. So
always got to ask.
Yeah.
Shawn, do you know off the top of your head, and this is a random question for you, like what % of the Keyrenter portfolio was Section 8?
I don't. I know we've placed more in the last year or so than ever, but I don't know.
But I want to bring it up because I've heard some people, obviously, like there's a lot of talk the last year with the Trump administration on how they're going to change all that. But I have not seen anything like officially come through or trickle down, other than I heard this anecdotal story and it caught me by surprise. Asked a bunch of other people. I've not heard other validation like that. So I think that's good news overall for landlords and good news overall for the Section 8 tenants as well.
Yep.
So we were talking about multifamily, and I mentioned this. So we did a 2 to 4 unit multifamily webinar a few days ago. So I have a fourplex, and so I get called on by a lot of commercial brokers who they play in the fourplex space. And a few months ago, either in November or December, got a call that basically the unit across the street, so exact same layout, exact same unit. Mine's in much better shape and updated, but same square footage and all that. They were listing it basically for what I bought it for in 2018.
Wow.
And then the broker called me last week and actually sold for a few dollars below what I bought it for. But it just tracks what we've been saying from the data, right? Like, oh, hey, multifamily prices are around 2018, 2019 type prices. And then you get the call like, oh, there's a direct comp of mine that's trading at the exact 2018 price. It kind of stinks right now, but that's why you also buy right. I got good debt on there, going to hold for quite a few more years to ride it out. But I share that because the inverse of it is it shows the buying opportunities right now in both, residential 2 to 4 unit multifamily, and both, especially in commercial, like 5+. I mean, there's a lot of like really distressed 5+, and I would say there's some really good deals in the 2 to 4 unit range. So that is, just another indicator that if you want to go out there and buy multifamily at good prices, man, go out there and make some disrespectful offers. Because I'll go back, I just listed, I think last year, I listed maybe 2 years ago, and 0 offers and no even lowball offers, no nothing, which just surprised me. And then of course, hey, I'm the seller in this situation, so I want the highest and best price, right? But then there's part of me, it's like, man, someone just lowballed me because I want to see what the market is. But it's a good reminder, go out there and lowball on properties because there are deals out there. But you may have to lowball a few, but what do people say? No, whoop-de-doo.
Yeah. I guess you hurt the seller's feelings, but if you send out 50 of them, you'll probably forget about that first lowball offer you did. So
I've had way worse rejections than that in my life,
Yeah,
right. No kidding.
Yeah.
Well, yeah, if you want to, well, especially on the buy side, you're at 100% right for 2 to 4s and 5. I'm sure 5+ because the debt structures are so bad. And yeah, Chris, I guess good thing you got that low interest rate. I guess
3.5.
You're gonna enjoy that a little longer, Chris.
Nice principal reduction.
Yeah.
You've had it for what, 4 or 5 years now?
No, since 7 or 8 years now.
Okay. Yeah.
I refied.
Okay. You refinanced.
I
down to the
refied.
good rate.
I mean, I think I got very lucky and probably refining about the best time because getting a 3.5% on a fourplex is pretty nutty.
As an investment property, because you were not even occupying it at that point.
Pure investment property. And I was like, well, that's just nuts. So I think I got very fortunate where I just timed something right for once, But that's a little luck in there. Jenny, you got any anecdotal stories or comps you've been following for like duplexes, triplexes, fourplexes down in your area?
No, not really. Just I'm seeing them sit for a while and then they'll get pulled, and every once in a while they'll close. So it's kind of interesting to peek around at that. But yeah, I think if you have a 2 to 4 unit and it's working for you and you're not bleeding every month, just hang on.
And then on that note, I saw this article in BizDen on February 6th. Lender forecloses on 4 central Denver apartment buildings. These are all like 20 to 30 unit property types in the Cheeseman Park and Cap Hill areas. So they're kind of right on the borders of both. But the buildings were previously owned by New York-based Urban American Management, which bought them simultaneously in December 2020 from a single seller. Urban American, which did not respond to a request for comment, paid $30 million for the buildings, financing the deal with a $23.1 million loan from MF1 that was supposed to be repaid January 2024. In August 2024, MF1 successfully petitioned a judge to appoint a receiver to oversee the properties. The lender initiated the foreclosure process last June. But then there's another note in here saying there were no bidders at auction on these properties, which just surprised all of us. Again, we don't know the details. I've never been part of a commercial foreclosure process. But it was really surprising to see even, I guess, no bidders on there. But more opportunities out there where there's distress. And, I think there's a lot of landlords out there where, I think one of the plays right there for active landlords that really want to scale their portfolio, if you own a bunch of like single family homes, while you're not going to get like the top dollar you got 3 or 4 years ago, you can still sell at a pretty good price, right? Hey, you might take a 5 or 10% hit from where the top was a few years ago, but you can go in here and scale up into like small multifamily, a 10, 20 unit, do a 1031 exchange. Hey, if you're selling at a 5 or 10% discount over here, but you're buying at a 30 or 40% discount on multifamily, I have seen some people make that trade. I think it's a brilliant play if you want to scale up for the efficiencies of multifamily and also just to, get into a better basis. So I'm a big fan of that strategy because you can just buy some really great assets at a discount right now.
Yeah.
Are you going to scale up to bigger multifamily, Jeff?
I look at my lifestyle and I'm like, if I really want a 30 unit, and that's just, it sounds good on paper, Chris. I agree. Like unit count's impressive to go from like a 1 to 30 unit. But I'm also like, do I really want more units?
Yeah.
I'm kind of like, I like a right size portfolio right now. So not yet. I'll put it that way. If I can change my mind, ask me to wait.
You're open. Yeah.
I'm not against.
You can be persuaded.
I do think the opportunity is there. I think it's like 2009 for commercial instead of residential. And I think the debt structure is really what's driving them downward, unfortunately, because they did these 5-year adjustable rate mortgages in 2021. And it worked at those numbers.
Yeah, but we did a podcast 2 or 3 weeks ago with a couple commercial multifamily brokers, North Peak, and they're, I think, some like the highest transacting volume brokers in Denver, if not the highest. And they were just giving some great examples. So I'd recommend listening to that podcast. But same thing, like they are seeing some just steep discounts in commercial multifamily. All right, Jenny, here's an article that you shared a couple days ago. Realtors say it's still a buyer's market in Colorado, but high housing costs keep renters renting. Can you summarize this? And then you did a really cool comparison.
Yeah. So the article is essentially saying that kind of what we talked about in our market stats was that the buyer's market is persisting. There's more inventory for people to choose from, especially compared to a few years ago. Sales and prices are kind of leveling off, even dipping in a couple of areas. But they're saying affordability is still a big barrier. They said that the monthly cost of owning a home is roughly double the cost of renting when you factor in mortgage, taxes, insurance, and maintenance. So I thought that was kind of really like the key point that this article was making. And they also think that their prediction from the Colorado Sun is that 2026 conditions are going to look similar to 2025. So I just was curious. I was just thinking of this one property that I have. It's a detached 3-bed, 1-bath, 1-car garage, just a very typical starter home, right? And just, putting down 5% at a 6% interest rate, putting in what I'm paying for property taxes. I lowered the home insurance a little bit since I'm paying for, a landlord policy, and just into, mortgage calculator online. And it came out with the payment was about $2,100 a month with PMI. And I'm currently renting out that home to a family for $1,750. So, the $2,100 does not include any repairs or CapEx or anything like that. Whereas their $1,750 rent, I'm on the hook for all that stuff that needs to be done. So, obviously I just wanted to caveat that this is purely from a monthly cash in, cash out perspective. We're not talking about any of the other values that real estate could bring, not wealth generation or the ability to stay in the home as long as you'd like, the permanence factor on that. But just simply looking from a cash in, cash out, I think that renting this house would be a much better deal than buying it. In this particular example, especially they don't know how much their monthly maintenance is going to be on top of that. So add in a few $100 a month for that, and it is quite a bit different.
All right, Troy, last I'm on the docket here. There's been some move in the 10-year, which means mortgage rates have moved. And I think it's about 2 weeks ago now, President Trump announced his new nomination for a Fed chair. So what is happening in the lending world, and what are you hearing from your data sources?
Yeah, I think there's some positivity with Kevin over Jerome coming in, that he's going to be a little more forward-looking than backward-looking. That's always been a big complaint with the Fed, is that like driving around looking in the rearview mirror with past data and not doing a good job with projecting, and then that's why they don't react accordingly, and they get us into these bad situations sometimes. So we'll see how this works. You don't want it to be too politicized by any means, because that's a bad thing. You want them to definitely work off the data and be slow, because you overreact, you can cause some havoc in the markets in a big way, right? Mm-hmm. So they need to do it measured, because you don't want inflation getting out of control, which is the arch enemy of mortgage interest rates, mortgage-backed securities. So I think there's some positivity there. So we'll see if he brings in some cuts. The labor market still continue to show weakness and softness there. The numbers, just even hearing this morning for the holiday buying season, was not as robust. And there's a lot of lagging data, which is kind of hard for them to make their decisions off of. But I think there's still some positivity there. I tend to be an optimist. You get Jeff and I together, and then we get real optimistic, right? About things. I still think there's things to come, and some better rates to happen, hopefully to soak up some of that inventory for us that we're seeing come online. So the rates drop a fair amount. We could see this start to move in a positive direction pretty quick.
The forecasts or predictions for where mortgage interest rates will be by the end of the year, did it change any once Trump nominated?
I haven't heard that to speak intelligently to it. I do know that, and I think we mentioned in some of our last get-togethers that from last year at this time to where we're at now, we're seeing, at least a 3/4 improvement. And so I'm actually seeing some people refinance the deals that they bought last year into better positions. No, nothing dramatic, but 0.5–0.75% improvement to the interest rate. That's worthwhile. Makes a good number. On borrowers, no cost refinance to shave off $155 a month. That makes a lot of sense.
Yeah.
On his property.
Is that what you've seen from some rough savings there?
Yeah. For that particular one, another one's getting close to $300.
Okay.
With a little bit of cost. I'd like to see a return on investment when you're starting to pay cost in a year. 2 years, I think, is not unreasonable. 3 years, I think you're getting on the edge of it. But if there's no cost associated with it, you're just taking the rate and we're covering the closing cost for you. You're saving $155. That's worthwhile for a few hours of your time to put that together. So, seeing that, which we didn't see any of that last year, especially this time last year. So, again, I feel like there's some positivity going on there. So we'll see. Big world events can move the markets in pretty dramatic ways. So it needs to kind of click down and then sustain that for a period of time. It can't be just this little quick flash of a rate improvement and then it goes away. So if we see it sustain for several weeks, a month or two, could see some good things.
Along those lines, though, this is a buyer's market, Chris. Have you ever seen a buyer's market since you've been in Colorado?
Mm-mm.
Like a true buyer's market where you actually could make this, you could make disrespectful offers and get away with it and not be yelled at.
And get it.
And actually potentially get it. And they could say yes. You could probably throw 100 disrespectful offers and I bet one of them will say yes to you.
Well, and I think that's and that's right. There's a lot of stress in multifamily. No. There's also just a lot of inventory in single family. Mm-hmm. There's a lot of inventory in condos out there. You can go out there and be selective. But it comes down to going through numbers and putting out some disrespectful offers. And all right, do 30 or 40 and 1 or 2 sticks. And that's what you're looking for.
Yep. Mm-hmm. And it's only buyer's market first. I feel like buyer's markets are really short. And this is one of the few times we do have a buyer's market. And everyone listening should take advantage of it because how short it is. And if rates do drop, if Troy helps, the rates come down another percent. Yeah, it's just going to be a frenzy all over again.
I've been making some calls to Kevin already.
Yeah, you guys are texting him.
Yeah. I'm blowing off Jerome. He's out. Kevin's in.
All right. So just to recap a few important points from the podcast. It was a great pod, by the way, guys. Thank you for showing up and sharing your thoughts and expertise. But look for opportunities in new construction properties. Look for opportunities in multifamily, and go out there and make some disrespectful offers for any of those, including single families as well. And if someone goes out there and starts buying a bunch of condos or figuring out where the condo market is going, let us know what you're doing and come on the podcast to talk to us, because that's the one asset class that's still just crickets that I'm hearing from. But I'm waiting for someone to say, hey, prices are here. I got the strategy. Ready to go out there and start executing. But there is lots of opportunity. Remember, when the headlines stink, it's often a good time to buy for long-term wealth building. But if you guys ever need help with, looking to have a property manager take over your property, talk to Shawn at Keyrenter. Need help with a buy or a refi, come talk to Troy at Nova Home Loans. If you're looking to come out here and buy a rental or sell a property, come talk to Jeff or Jenny. But just a big thank you guys for showing up, and another great month.
Great. Thank you, Chris.
All right, bye everyone. We'll see you next month.